Freelancers and sole proprietors are both self-employed individuals, but they often misunderstand the tax-related distinctions between these two roles. While they may seem interchangeable, especially in casual use, the IRS and tax professionals recognize nuanced differences that can affect filing requirements, allowable deductions, business structure, and long-term financial planning. Whether you're just starting your journey in self-employment or looking to understand your current tax obligations better, it's crucial to grasp how these roles differ. In this video, we explore the top 10 common differences between a freelancer and a sole proprietor, tax-wise, to help you stay compliant and maximize your tax efficiency. 1. Definition and business identity. A freelancer is typically someone who offers specific services, like writing, design, coding, or consulting, on a project or contract basis, often to multiple clients. The term is informal and widely used in creative or digital fields. A sole proprietor, on the other hand, is a formal business classification for someone who owns and operates an unincorporated business alone. While all freelancers are technically sole proprietors by IRS standards, not all sole proprietors are freelancers. The difference lies in how each perceives and presents their business. Freelancers see themselves as independent workers, while sole proprietors may treat their operation as a more traditional business entity. 2. EIN versus SSN usage. Many freelancers operate using their Social Security number, SSN, especially when starting out, since they often work under their own name and don't hire employees. Sole proprietors, however, more commonly apply for an employer identification number, EIN, even if they don't have staff, because it offers a layer of privacy and legitimacy when filing taxes or opening a business bank account. While not required unless you hire employees or form a partnership, an EIN is recommended for sole proprietors who want to grow or create a brand identity separate from their personal name. 3. Business name and DBA, doing business as. Freelancers usually conduct business under their personal name, but sole proprietors often file a doing business as DBA to operate under a unique business name. This impacts tax documentation and invoicing. With a DBA, a sole proprietor can open a business bank account under their business name and gain credibility. From a tax standpoint, the IRS treats both the same if they're unincorporated, but having a DBA can help sole proprietors separate personal and business finances more effectively, leading to better financial tracking and deductible accuracy. 4. Types of income and 1099 forms. Freelancers primarily receive income via Form 1099 NEC, which reports non-employee compensation of $600 or more from any client. They usually have multiple sources of income across various short-term gigs. Sole proprietors may also receive 1099s, but their income sources can include product sales, service income, and rental activity, expanding beyond just contract work. Because sole proprietors often offer goods and services beyond time-based labor, their income tax situation may be more complex, especially with mixed revenue streams. 5. Business expense categories. Freelancers often claim deductions specific to their trade, such as creative software, advertising, and equipment, which are directly related to their field. Sole proprietors can deduct similar expenses, but they may also deal with inventory costs, employee wages, office rent, and marketing budgets. While both can write off necessary business expenses, sole proprietors are more likely to track broader categories of expenses, and may need to follow additional IRS guidelines, like cost of goods sold, COGS, if they sell physical products. 6. Self-employment tax filing requirements. Both freelancers and sole proprietors are subject to self-employment tax, which covers Social Security and Medicare contributions. As of 2024, the self-employment tax rate is 15.3% on net earnings. However, freelancers who operate casually may not always meet the IRS filing threshold, usually $400 in net earnings, whereas sole proprietors often consistently exceed that amount, triggering quarterly estimated tax payments. Freelancers sometimes mistakenly believe they don't have to pay self-employment tax if they have a full-time job, but any side income meeting the threshold is subject to it. 7. Quarterly estimated tax payments. Freelancers may underestimate their tax obligation and fail to make quarterly estimated tax payments, especially if they view their income as irregular or minor. Sole proprietors, especially those earning more consistently, are more likely to plan for and submit Form 1040s each quarter. Failure to pay these taxes can result in penalties and interest, regardless of whether you are a freelancer or a sole proprietor. But in practice, sole proprietors are more diligent due to formalized business practices, making it a more routine part of their operation. 8. Business licenses and local tax requirements. Freelancers often skip registering their business unless required by clients or local law. Sole proprietors, especially those offering services to the public or selling goods, are more likely to obtain local business licenses or pay state, local business taxes. Some jurisdictions require registration regardless of business size or type, and sole proprietors are typically more aware and proactive in ensuring compliance. From a tax perspective, these registrations can affect what records you need to keep and how your business is reported at both the state and federal level. 9. Retirement contribution options. Freelancers may not be aware of or take advantage of tax-advantaged retirement accounts like SEP IRAs or solo 401ks, especially early in their careers. Sole proprietors, especially those treating their venture as a long-term business, are more likely to plan for retirement, taking full advantage of tax deductions for contributions. For 2024, solo 401k contributions can reach up to $69,000, depending on income and age. These retirement plans reduce taxable income and provide significant long-term financial benefits, but freelancers often overlook them due to lack of planning or awareness. 10. Tax filing complexity and use of professionals. Freelancers often file taxes using Schedule C attached to Form 1040, and may handle everything through tax software like TurboTax. Sole proprietors may also file Schedule C, but due to the broader scope of their business activities, like inventory management, employees, or multiple revenue streams, they often work with accountants or bookkeepers. Freelancers may not see the need for professional help until they face an audit or large unexpected tax bill. In contrast, sole proprietors, aware of the complexity of their deductions and reporting, are more likely to build ongoing relationships with tax professionals. Freelancers and sole proprietors share many similarities when it comes to self-employment, but key tax-related differences can significantly affect how each should manage their business, deductions, and filings. Freelancers often operate informally with limited planning, while sole proprietors tend to structure their business more traditionally, anticipating growth and compliance obligations. Understanding these distinctions, from income sources to retirement planning, is essential to managing your business wisely and avoiding costly mistakes. Whether you're freelancing on the side or running a full-time sole proprietorship, knowing your tax responsibilities ensures you stay compliant and financially optimized. If you're unsure where you fall on the spectrum or how to handle your taxes, consult a licensed tax professional to get personalized advice tailored to your situation.